Good morning, Black America, Grand Rising beloved. I'm Crypto Stock Markets, and here's what's moving the market today. Let's start with the weekend. Happy belated Love Day. And over the weekend, Bitcoin tried to make a move. Friday closed with a little stabilization, nothing explosive, nothing euphoric, just a little confidence creeping back into that market. Then Saturday came, momentum ticked up, buyers stepped in, social media started whispering about a rebound, but by Sunday, rejection. Bitcoin pushed towards that 70,000 psychological zone, and sellers reminded everyone that resistance is still resistance. As we step into Monday, Bitcoin is hovering in the upper 60,000 range after failing to hold that push, and here's what that tells you. This is not a collapse, but this is not a breakout either. This is tension. Now here's the part most people are ignoring. Leverage is heating up. Traders are stacking long positions, betting on a bounce. Open interest has been rising. That means borrowed money is entering the market. And when leverage builds during weakness, you only get two outcomes. Either you get a sharp squeeze higher or you get a violent flush lower. Leverage is like gasoline. It doesn't pick a direction, it just amplifies the spark. Now layer this on top. Retail investors have reportedly been accumulating during this dip. Now that matters because panic looks like exits. Accumulation looks like belief. When everyday investors step in during weakness, that tells you sentimental isn't broken. On the institutional side, Michael Saylor's company publicly reinforced that it could withstand a severe Bitcoin drawdown and still cover its debt obligations. That wasn't about predicting a crash, that was about signaling strength. Markets crash when big players are forced to sell. Right now, institutions are signaling they are not forced sellers. So what do we have? Retail buying, institutions reinforcing conviction, leverage building, resistance not yet broken. That is a high volatility setup. It's not drama, it's just compression. And compression always leads to expansion. The only question is direction. Now let's zoom out because another headline went viral over the weekend. The U.S. government is collecting donations to help pay off its $38 trillion debt. That headline sounds very, very dramatic. It sounds desperate. It sounds like the country just passed around a collection plate. But here's the truth. The Treasury has had a gift to reduce the public debt portal since 1996. It's not new. It's not an emergency policy. It's not a sign of immediate collapse, and almost nobody donates in meaningful size. And even if someone wired $10 million tomorrow, it would not move the needle on $38 trillion. So the donation form isn't the story. The debt is. The chart doesn't lie. The acceleration after 2008 was real. The explosion after 2020 was historic. And now we're in a higher interest rate environment. Servicing that debt costs more. Refinancing that debt costs more. Interest payments are rising. That is structural pressure. Now, I'm not fear-mongering. I'm not telling you the dollar collapses tomorrow. But I am telling you this. When debt grows faster than productivity long term, something eventually adjusts. That adjustment could be inflation. It could be policy reform. It could be monetary innovation. And this is where Bitcoin fits into the larger conversation. Bitcoin was built for environments where long-term fiscal sustainability is questioned. It was designed for distrust in monetary expansion. Now, whether you love Bitcoin or hate it, the reality is simple. Markets are slowly pricing structural shifts, debt expanding, interest costs rising, AI regulation expanding, retail accumulating. This is not a simple bull market sprint environment. This is a structural transition environment. So what should you watch this week? First, price structure. If Bitcoin reclaims and holds above key resistance, momentum can accelerate fast. If it falls again and loses mid 60,000 support leverage could unwind quickly. Second, macro dollar inflation. Economics print, liquidity conditions. Crypto doesn't move in isolation anymore. Third, sentiment. We are not in a euphoria. We are not in total despair. We are in compression zone, and compression never lasts forever. So here's the discipline. If you're trading short term, control risk tightly. If you're investing long term, control emotion. Volatility does not mean failure. It means repricing, and repricing is part of maturation. Retail is stepping in. Institutions are reinforcing conviction. Debt is expanding. Macro pressure is real. This isn't chaos, this is evolution. I'm Crypto Stock Markets, keeping you 2 steps ahead of the market on Good Morning Black America.